is open float, and we're going to look at open float inside of a range. Okay, so this is going to be for your study journal, internal range liquidity hyphen, which is a little dash, and you're going to write open float. All right, internal range liquidity dash open float. So we're looking at a 15-minute time frame on the gold market, and this high here to this low here is our parent price swing. We have a lower level swing, which is this high to that low, and then we have a lower level swing within it, which is this high to this low. Okay. Common question is if I'm using a fib and I want to find equilibrium, or if I want to find optimal trade entry, which swing high should I use? Well, this high to this low is your parent price swing. You always first want to consider that. But then inside of that range, you want to look at how price has rebalanced. We had this big sell-off here, and then we came all the way back up and filled it in. In other words, what I mean by it, all these down closed candles, price only went lower. And then we had this candle here, here, and here where it spiked up right to the bottom of this last up closed candle. So all this down move had been rebalanced with up movement. So it's kind of like that paintbrush analogy. Paint applied to the wall, stroke down, and then you stroke it back up to fill in any little spots that didn't get paint. And then it's free to go lower. Okay, that's what rebalance is. Since this high to short-term low to this high, this has been rebalanced. We don't put our fib on this high. We use this one. Why? Because this swing has imbalances. This high rebalanced all these down closed candles. Now these down closed candles need to be rebalanced up to this candle's low, right at 1509 and 98 points. We'll just basically call it 1509. The high to this low here is now our dealing range, because we don't need to worry about this high because it's already been rebalanced. So price is only going to be reacting and keying off of the range between this high and this low. So inside of that range, there's going to be liquidity. That means above this low and below this high, all this range, internally speaking, what is the liquidity that exists within that? Well, let's take a look at it. We have this candle's low to this candle's high. In here, that midpoint is this red line, which it hits it right there perfectly. Okay? It also is basically the middle of this low to this high range. So this bearish order block, essentially, that's the midpoint or mean threshold of that same level. Okay? In this area where this line is, between the mean threshold of the bearish order block and the midpoint of the fair value gap, in this form is a SIBI, sell side imbalance, buy side inefficiency. The midpoint is there. With that being said, we know that there's going to be a large pool of internal range liquidity at this area or at that price. What's the price? Well, the line shows essentially 1508. Okay, so 1508, round that to the nearest 5 level. What would that be? Remember, if we're down here and we're coming up, reaching for liquidity, the nearest 5 level would be what? 15010 or 1505? 1505, because you're going to round down, because again, the effect of spreading open to absorb liquidity is a function of the broker side. Trading to the specific price levels is interbank level. We're talking about internal range liquidity and open float. Where is the resting orders above these this consolidation. In other words, what I'm saying is in here, when price was hanging down here, we know that this candle's high, this candle's low, and this candle's high here, there is a gap. We split that in half, that's this level right here. And it's 1508. Down here, what's the nearest 5 level to this level here without going over it? 1505. So you could be a seller at 1505 in here with the expectation that we could see a run all the way up to this candle's low and into that candle. So your stop has to be above that. Okay. Secondly, we have the range itself, the high to the low. We have optimal trade entry here, 70.5 level. Perfectly hit here. 2, 3 times and then expansion down. Okay. We have relative equal lows. You can be a seller here and buy it back below these equal lows. The fib, with that proper swing from high to low, we can use our targets, which is 127 and 162 expansions on the fib, calling for 114.85. Okay, so 114.85 would be our downside objective, and the market trades down into a low of 114.85. Okay, this area here, we had a SIBI, sell side imbalance, buy side inefficiency, and you could be a seller here at the bottom of that candle there. So we have a bearish order block, SIBI, off to the races. So a seller here and a seller here. Notice that those signals occur at and above equilibrium between the low and the proper swing high. This is open float within internal range liquidity. We're going to talk a lot more about these types of events, but I want to kind of like bring more into the depths of why I don't need market profile, footprint, ladders, DOMs, depth of market, all those things that are out there that feel like makes you like institutionally minded. It's not needed. It's not needed. Everything between the open, high, low, and close tells you everything. The only element you need next is time. Okay? So until I talk to you over the week that's coming, I wish good luck.